All right, so let's talk about today the changes that certain banks are doing around trust and company lending. And if you're an investor looking to scale out a portfolio, how that will actually affect you and your growth. First things first, banks change policies all the time. This is no different than when we look at back when the Royal Commission was on and banks and lenders changed the investment finance. Some banks got rid of interest only for investors, changed their policies, made it very hard. This is simply due to, let's assume a bank has 100 loan applications. There's only a percentage of those that are allowed to be actually aligned to each style of lending. So in this case, let's look at Macquarie Bank. They have 100 loans. Potentially too many of those loans now have been trust and company borrowings. So they have to relook internally at their requirements and pull out of the market. I would dare say this will only be for a short term. Banks are clearly in the business of lending money, making profits. So once their book realigns, they'll most likely reopen up and look at trust and company borrowing again. But if you're an investor and you're sitting there on the side and you've been hearing all this talk about why you should buy through companies, why you should buy through trusts, this hasn't changed. It simply means you need to look at different lender alternatives to continue to grow your portfolio. So I was actually talking with a client just yesterday, and we're looking at their portfolio and how we're working with them to scale it. We originally actually had planned to use Macquarie Bank as part of this lending, and we obviously can't do that now. So it's simply a shift. And sometimes that shift means maybe short term, you pay a slightly premium in rate. But what you need to make sure of when you're building a portfolio, you're not solely focused on rate. You're looking at what's going to actually continue to grow your portfolio. I'll give you a perfect example with this particular client. Is they're now going to pay a 0.5% increased rate to get the same security and assets as they were previously to this change. The difference to them is they can either say, hey, we're not going to pay an extra $2,500 to $3,000 a year of interest, but in doing so and avoiding the purchase, how much are you actually losing out in long-term capital growth? So sometimes we'll look then to structure your portfolio because of these changes. Different lender might be a slightly higher rate. Then we simply review this in 12 months, see what's happening out there in the lending space, and say, can we now shift that lending back to a lender that's going to give you a more attractive rate? Market shifts, lender policies, they're always changing. It's now becoming more prominent because there's so many more investors out there in the marketplace. So as I always say, make sure you know your end goal. The way you get there may change, the banks you use may change, but the end goal doesn't. This is where it's so important when you're working with the right professionals to understand and make sure they understand how you should actually pivot with each different transaction and with each different move in the market to understand what banks are actually allowing you to do what out there in the marketplace. Keep the main thing, achieving your goal, whatever that is. Get absolute clarity. Let the professionals work backwards for you to work out, well, what's the roadmap getting there? Do we sometimes need to take that detour for you? But at the end of the day, so long as you get to the outcome you're trying to get to, that's the most important thing. What's also really important when you're diving down the avenue and the path of buying assets through trusts and companies is making sure, again, you're working or your lender is working with your accountants, because different trust structures actually fall out certain banks' lending profiles. To give you a perfect example, we're working with a client currently. They've set up a unit trust. The unit holders of that trust are then family trusts. They then have a corporate trustee, and then the individuals. Because of the amount of layers that's set up through that, we understand why the accountant has done it this way. But when a bank looks at it, and they look at the complexity of all the entities, a lot of them will say, no, we're not going to lend to that certain structure. Then you need to go outside of the big four, the big six banks, and look at, well, if that's the structure you really want to go down for whatever it is for your tax and security purposes, then we need to look at these specialist lenders that are open to actually exploring these more complex trust structures. So if you're just embarking on your journey and you're working with your accountant or your financial advisor, make sure that they actually understand the intricacies of how they set up their trusts and the corporate structures to make sure it fits with the lenders you really want to work with.